Today, the Bitcoin world is more divided than ever. On one side, you have the veterans, people who have lived every cycle since 2013 and are convinced we're entering the final phase before a major correction. On the other side, you have the new giants, funds, banks, institutions, who argue that this time is different, that the old cycles no longer matter, and that global liquidity is now the real force driving Bitcoin. So, who is right? Are we seeing the end of the fourth major cycle? Or are we witnessing the beginning of an entirely new era for Bitcoin? Is a brutal correction coming? Or are we watching Bitcoin break every pattern from the past? Most investors make decisions without understanding this conflict. And that's exactly why they lose money. Because Bitcoin today is no longer the wild speculative asset it was 10 years ago. But it's also not the perfectly controlled institutional product that some people imagine. If you want to protect your money, grow it, and prepare for what's coming, you need to understand the two forces pulling Bitcoin in opposite directions. And once you understand them, the way you invest and the way you prepare for the future changes completely. Right now, Bitcoin sits below the $100,000 mark, with corrections that have pushed it toward the mid-90,000 range. To many people, that looks like weakness. But its current behavior doesn't resemble anything we saw in earlier cycles. In 2017 and 2021, when Bitcoin was near its highs, we saw explosive volatility, massive candles, panic, euphoria, rumors, influencers promising the moon. Today, the movement is calmer, heavier, and more controlled. Almost as if Bitcoin has entered adulthood. Why is that? Because the money that moves the price today is not the same money that moved it years ago. Back then, the narrative was driven by retail investors, ordinary people reacting emotionally on Twitter, TikTok, and YouTube. Today, the flow comes from a different place. Spot ETFs, funds, banks, insurance companies, and corporate treasuries. That money doesn't buy because it's excited. It buys because the model says so. It doesn't follow influencers. It follows mandates. It doesn't panic. It rebalances. And that changes everything. Less explosive volatility, more macro-style behavior, more correlation with global liquidity. That's why analyzing Bitcoin as if it were still 2017 no longer works. The environment changed. The players changed. And when the players change, the rules change too. But even though that market evolved, one force never disappeared. The perspective of the veterans. The people who lived through every boom and bust. For them, nothing happening today is really new. They argue that we've seen this 3 times already, and every time it ended the same way. Their logic is simple. Bitcoin has an internal clock that ticks every 4 years. Each halving reduces new supply and creates a period of programmed scarcity. Price climbs, euphoria builds, and then a major crash follows. Not magic, human psychology. In 2013, Bitcoin rose thousands of percent and then crashed over 80%. In 2017, the same thing happened. In 2021, the pattern repeated again. 3 cycles. 3 similar structures. Different narratives, same psychology. That's why the veterans are not scared. They're certain. To them, Bitcoin today, whether at 90,000 or 100,000, is replaying the same pattern. First it breaks the all-time high, then it cools down, and then it drops hard. From their perspective, current levels resemble 60,000 in 2021 or 20,000 in 2017. Zones where everyone still believed there was plenty of upside, when in reality, the decline was about to begin. Their central argument is simple. It doesn't matter how many ETFs exist. It doesn't matter how many banks adopt Bitcoin. Greed and fear remain the same. People still buy late and panic early, and that is why they believe a major correction is inevitable. According to this view, Bitcoin could drop 30 to 50% before starting a new recovery phase. For veterans, this isn't pessimism. It's statistics, experience, and memory. But what if this time truly isn't the same? What if the force driving Bitcoin today is no longer the same force behind the earlier cycles? Because there is something now that has never existed at this scale. Institutional money. And institutions think very differently from old-school Bitcoiners. From this institutional perspective, the 4-year cycle is no longer the dominant factor. The real driver is global liquidity, the expansion or contraction of money across the world's financial system. Since spot ETFs were approved, Bitcoin changed hands. It's no longer primarily held by retail investors. It's held by institutions like BlackRock, Fidelity, Vanguard, Franklin, and RK, entities managing trillions of dollars. These institutions don't operate on emotion. They don't react to memes. They don't buy because Bitcoin is going to the moon. They buy because their models require it. They sell because flows demand it. They rebalance because their risk policy says so. That creates a completely different market. From this lens, what moves Bitcoin now isn't the halving, it's interest rates, global liquidity, central bank decisions, inflation, and macro conditions. When central banks print more, ease conditions, or lower rates, risk assets rise. When they tighten, drain liquidity, or hike rates, everything falls. And now Bitcoin responds exactly like the Nasdaq or S&P 500. Volatility has cooled. Extreme moves have softened. Bitcoin behaves like a global macro asset, not just a speculative experiment. So, who's right? The veterans or the institutions? The truth is, both are right, but only partially. The 4-year cycle still matters. Human psychology still matters. But global liquidity now plays a far bigger role than ever before. Bitcoin is no longer just a cyclical asset. It is also a macro asset. And when you combine cycles with liquidity, you realize something important. The future will not be a repeat of 2017 or 2021. It will be a hybrid, new territory we've never seen before. To navigate new territory, you need new maps. So let's get into the 4 realistic scenarios that could play out over the next few months. Scenario 1. Stability and a sideways range. Bitcoin stays between $90,000 and $110,000, moving calmly without dramatic spikes or crashes. This happens when ETF flows balance out and global liquidity remains stable. For you, this is a perfect period to accumulate quietly while others get bored. Scenario 2. A moderate correction. A drop of 10 to 30%, pushing Bitcoin towards 65,000. This wouldn't be a collapse, just a natural reset. For you, this would be one of the best long-term buying opportunities of the decade. Scenario 3. A deep correction. A drop of 30 to 50%, taking Bitcoin into the 45 to 60,000 range. Painful? Yes, but not unprecedented. This could be triggered by a liquidity squeeze, aggressive rate hikes, or a financial shock. For new investors, this would be a massive opportunity. For large investors, this is where risk management becomes essential. Scenario 4. A new bullish leg. A 15 to 40% rally, taking Bitcoin above $130,000 to $150,000. This could happen with strong liquidity, institutional inflows, and positive macro conditions. In this scenario, the market would show that old patterns are breaking and Bitcoin is entering a new phase. So which scenario is most likely? The most reasonable expectation is a sideways range with periods of correction. Liquidity still exists, but it is no longer aggressively expanding. That creates a mixed environment, neither euphoric nor catastrophic. The key lesson is simple. Do not prepare for one scenario, prepare for all 4. Bitcoin does not reward the person who guesses correctly. It rewards the person who is prepared. Now that you understand the scenarios, let's talk about how you should act depending on your situation. If you have 0 Bitcoin, this may be one of the best moments in history to start. If a correction comes, you can buy lower. If price stays stable, you accumulate in an ideal range. If it rallies, today's prices may never return. Your biggest risk is staying out. Start small and buy consistently. If you are a small investor with less than $100,000 of total net worth, your priority is accumulation, not timing. Dollar cost averaging is your best tool. Corrections are your allies. You are building a base, not chasing quick wins. If you are an advanced investor with more than $100,000 of net worth, your focus is risk management, not accumulation. You need a long-term core position, strategic liquidity to buy dips, and simple hedges to protect against large swings. Your goal is stability and discipline, not perfect timing. Above everything, remember one truth. Nobody knows exactly what will happen to Bitcoin. Not you, not me, not the veterans, not the biggest funds in the world. Anyone who says otherwise is lying. But one thing is absolutely certain. The future rewards the people who prepare, not the people who try to predict. If this helped you understand the present and the possibilities ahead, make sure to subscribe and tell me in the comments which scenario you believe Bitcoin is in today and why. See you in the next video.